Hello everyone. Our topic for today is bond market. Debt forms an important part of asset allocation. Debt instruments are considered less volatile than equity market and offer fixed income in form of interest. NJ India Invest offers a platform through which NJ partners can offer variety of fixed income instruments to their clients. Clients can either buy bonds from primary market or from secondary market. So let us see the primary bond market and secondary bond market in details. Primary bond market. New bonds are first issued in the primary market. The issuer issues the bond first time to the eligible investors such as mutual fund, insurance companies, corporates, bank, trust and individuals, etc. The primary market issuance are open for a specific time, generally for 3 to 15 days. After the bonds are allotted to the investor, they are listed on recognized stock exchange, where the bonds can be bought and sold in the secondary market. All major issuance are made available on NJ platform. Secondary bond market. Secondary bond market is a place where bonds are traded. It is a place where investors can buy and sell their bonds to other investors. Secondary bond market offers an exit route for original investors, those investors who are invested in the bond during the primary issue, and entry route for new investors who could not invest in the bond during the primary issue. Secondary bond market are a good substitute for fixed deposits. Clients who want fixed interest and do not want exposure in equity can also invest in secondary market bonds. By investing in secondary market bonds, investors will not only get better yields than fixed deposits, but advisors will also get control on clients' investment. Advisor will know what is the debt exposure of his clients. Investors can invest in bonds issued by Government of India, public sector undertakings and private sector banks and companies. Some of the key features of secondary market bonds are: secondary market bonds offer fixed coupon. The coupon is payable monthly, quarterly, half-yearly, annually or even on maturity. The frequency of the coupon payment is pre-decided by the bond issuer. The interest payable could be either taxable or tax-free. That is, the interest earned on the bond could be either taxable or tax-free. There will be no TDS on interest payable on taxable bonds if the bond is bought in demat mode. That is, if bond is bought in demat mode, TDS on interest will not be deducted. However, one thing we should always note that at NJ, we only offer bond in demat mode. Bond can be purchased either at face value, that is during the primary issue, or at market price, that is from secondary market. If bonds are purchased in the secondary market, then it can be either bought at clean price or at dirty price. Clean price does not include any interest that has accrued since last coupon payment, and dirty price is the price of the bond which includes interest that has accrued since last coupon payment. For example, if the clean price of a bond is 100 rupees and the accrued interest is 6 rupees, then the dirty price of the bond will be 106 rupees. In simple words, we can say dirty price is equal to clean price plus accrued interest. Let's take one example for better clarity. This is an example of secondary market bond. The name of the bond is 10.75% IDBI Bank Perpetual Bond. The face value of the bond is 10 lakh rupees. The coupon, that is the interest rate, is 10.75% per annum. The date of call is 17 October 2024. This is a date on which the bond can be called by the bank. Interest payment date is October 17 and the interest will be paid annually. The clean price is 99.40 and yield to maturity of the bond is 10.85%. The rating of the bond is BBB+. Let us assume that the investor is going to buy this bond today, that is on 19 December 2017. So the settlement date will be today's date. Let us calculate the dirty price of the bond. Dirty price is a sum of clean price and accrued interest. So first, to calculate dirty price, we need to calculate accrued interest. Accrued interest is the interest accumulated after the last coupon payment. So it will be calculated as annual coupon divided by 365 days and multiplied by number of days since last interest payment. So the accrued interest will be 10.75 divided by 365 days multiplied by 63. Number of days since last interest payment is 63. The accrued interest per 100 rupees is rupees 1.8555. The total consideration will be dirty price multiplied by quantity of the bond. Here the quantity is 1 multiplied by 10,000, which is a multiplier. It will give us a total consideration of 10,12,555 rupees.